Daniel, how's it going today?
It's going well. It's going well. Have some obviously you don't need movies anymore. It's like real time exceeds. That joke. What was it? When somebody comes into a bookstore and starts looking for books, and they said, "Post-apocalyptic fiction has been moved to recent events."
Yeah.
So that's what it feels like when you read these news and everything. So you got to persevere.
Yep, got to persevere. So today we're going to talk a little bit about some of the recent earnings that we've seen. We're not going to go in depth. We're not going to do any fundamental analysis, but just last night we had, or I'm pretty sure it was last night, right, or this morning, Snap came out with their earnings. And what I thought was interesting about it is not just the move in the stock, which is drastic, but also what the implications are for the U.S. economy, which is what we've been talking about in the past few podcasts here, or video casts, whatever you want to call these. One of the things that they said was that they saw a massive slowdown in advertiser revenue, and that can really speak to this slowdown in the economy. And what I think is interesting is that there's been a lot of talk that a lot of these earnings misses and a lot of this has been priced into the market. And that's kind of behind some of these, buying rallies that we've seen. But these Snap earnings kind of make me think that maybe we're not quite at the end of this yet.
Yeah, I think that maybe many individual misses are priced in, but what's not priced in is the interaction of different factors. And this is what we're seeing last couple of shows. If you missed our show with you on investing counterpoint for financial advisors, if you missed the shows, you can probably, wherever you're watching, you can check them out. But we talked a lot about the Fed really being intent on breaking inflation and might very well be getting to breaking the economy. But we also talked about the dollar. Right, the rise of the dollar is sounds very benign. I mean, it happens in good economic times, but in these times, I think rise of the dollar is a major threat to most of the economies and large parts of the U.S. economy too. But the Fed's actions and the rise of the dollar are obviously interrelated. I think that the third factor that we're seeing now with Snapchat or Snap. We've seen it with Netflix. I mean, Netflix is a train wreck. We're seeing that the tech sector, which was long a driver of financial markets. I don't want to say a driver of economic growth because I don't believe it drove that much economic growth, but it was a driver of the financial markets that is coming to a halt. And I think those things are not independent. I mean, it's been long my opinion that large parts of the tech sector are only alive. They're not just alive. I mean, they're huge unicorns because of the 0% interest rate that they get access to. Once that's gone, most of them will be exposed to competition, and eventually they're gonna have to really come down. And I think that's what we're seeing, with Netflix, with Snap, and the advertising revenue is so all these factors are interrelated. When people think about slowing down in earnings, well, it's one company announcing bad earnings, but this is not what we have. We have many factors coalescing together, and we'll see where it goes. But my opinion is, as a financial advisor, you need to really stress test for that. We already talked about in the last couple of shows stress testing for Fed's actions, stress testing for different moves on the yield curve, like a yield curve inversion. But now we can formally add to that stress testing internet, and that's what I think we could talk about today.
Yeah, I mean, just on the yield curve inversion, we've seen that kind of exacerbate in the past few days too. We've seen the short end, like the 6-month end, even continue to go up, while the 10-year, 30-year, have gone down, to get this, really pretty drastic inversion. If you just look at it from the last time that we did this podcast, that short end is above the points that we were looking at, and the long end is below the points that we were looking at. So it's even just continued to tilt further. But yeah, I think that you're absolutely right. These things are going to have implications in other ways, and they don't happen in isolation, right? So every scenario, every situation, every economic scenario that unfolds is a little bit different. And with this one, we have not only this inversion of the yield curve, but we also have the rising dollar, and potentially, we've already seen that the NASDAQ has been underperforming the rest of the market. So we've kind of seen that return to, I don't want to use value to value over growth that has worked this year in particular after not working for many, many years. And, we might continue to see that. So, as opposed to being at the end and having everything priced in, like we've been reading, you see something like Snapchat, which is down 40%. Well, clearly that wasn't priced into Snapchat, right? So it's not going to be, it's not like every single company is going to have this kind of reaction to it, but clearly some of these moves aren't priced in. And if you have enough surprises like this, you could certainly see a bit of a snowball effect in a sector like the internet sector.
Yeah, and that's why I think as an advisor, you should stress test for that. If you're not stress testing yield curve inversion, you don't know how your clients' portfolios will respond to that, because you can talk all day about stocks and they're very important, but ultimately interest rates are what drives a lot of things, right? That's the price of money that will affect the retirement for your clients. It'll affect many, many things. And we're seeing the demand for the long-term treasuries, like we've seen over the past week since we did our show where we talked about the yield curve inversion. Like you're saying, you see people just going crazy, snapping up. Instead of snap, they're snapping up 30-year treasuries like it's never been done before. Like they're gonna run out of them. I know it's mind-boggling because those are created with just a strike of a key on the computer, but people buy them as if they're really gonna run out.
Yeah.
So, but I mean there are structural reasons for that. So, to summarize, the financial advisor, you must stress test for Fed actions. See our previous videos. Stress test for yield curve inversion, because that is clearly one of the possibilities that you need to understand. It is not trivial when yield curve inverts, because this is not a normal scenario. When this curve is steep, you're going to have weird effects that are going to impact retirement in a big way. When the rates are high at the short end and then really lower at the long end. But now we're going to talk about the tech. Everybody knows tech is risky. Tech and crypto have been hammered. Netflix, and so on. Twitter is holding up, but I mean they have a whole separate kind of idiosyncratic type situation. But what do you think? Let's look at how we can model the impact on the portfolio in the portfolio crash testing tool that we use. Let's say we model the rising dollar, which I strongly believe is a major underestimated threat to the solvency of many financial institutions worldwide. Because as the dollar rises, all of a sudden their assets are going to be marked. They have to be marked, unless they're given relief. They're going to have to mark them to market and probably add capital. Where's that capital going to come from? Hey, it's going to come from selling stuff.
Yep.
So we're going to get into a vicious loop. So how can financial advisors model this scenario, rising dollar index and internet stocks?
Yeah, so let's look at that. So I have these two up on the screen here: the Bloomberg US Dollar Index and the internet sector, which is the Bloomberg sector where Snap is. I mean, this is these are the Bloomberg sectors or
this is portfolio crash testing, the app for
the portfolio crash testing here. So I do have a question. I'm not certain that the dollar is going to continue to rise for the next 6 months or so. We've started to see it back off a little bit. We've seen it rise. But let's see what happens if it does continue to rise. I mean, this is because I think.
We're not predicting. That's why we're doing different scenarios every show, exactly, that you're, as a risk manager, you're looking at stress testing as a tool to crash test your portfolio, not to predict things. But ultimately, if the Fed is going to go through with what they're saying, the dollar is going to rise. I mean, where else are you going to get? Which central bank can increase interest rates by that much? They've announced that they're going to go to 3.5%. For the U.S. government, it is going to be hard enough. Just the interest payments alone will be massive, around 3%. Yeah. But for something like Japan, it is impossible. It is just strictly mathematically impossible to keep hiking there. Or ECB, if ECB starts hiking, and they've announced a 50 basis point hike, I think this is like a poker player desperate move, because how can you keep increasing? I mean, Italy is going to go out of the union. Basically you have no choice. So the Fed is the only entity in the world that's conceivably positioned to get to that interest rate. So the dollar will have to go up, at least in the short term, until there's social unrest maybe, and they're forced to print money again. But for the time being, we're seeing that.
Well, we've
I
seen
think it's very
Britain
plausible the dollar will keep going up. Maybe take a breather, but we'll keep going up.
It's plausible. Well, we've seen Great Britain have some massive hikes already this year, yeah, I mean, so we'll see if anybody else is, if they're poker players or if they're actually going to do it. They're actually going to follow through. But what I'm using here is the same portfolio that we used in the last video that we did. And basically all it is, it's a 60-40 portfolio, 60% equity, 40% fixed income. And it's really, pretty well diversified. I have the S&P 500, the EFA. I have some emerging markets in here. I have some individual stocks in here. I even have the Bitcoin investment trust at a very small level. And then I have a bunch of bonds. I have a Japanese fund and things like that. So this is, in no way a buy list or a suggested portfolio for anybody. I didn't look at any of these things underneath. What I wanted to do was find something with a reasonably diversified portfolio that when we stress test these things, we're getting something realistic as opposed to just, using two indexes like the S&P 500 and the ACWI all country world. So want to do something maybe a little more representative of a potential client portfolio. And we have, in terms of bonds, we also have some short-term and long-term.
Pretty sophisticated client too. I mean,
pretty sophisticated. What? You
have some treasury, you have some long-term bonds in there. I mean, this is a good portfolio, I think. I would like to own that.
You can, it's mine. Yeah, we even have some unis in here and things like that. But okay, let's go with this. So I went with the two factors that we're going to talk about today. We're going to limit it to the Bloomberg US dollar index, which is kind of the US dollar return against a basket of securities. You could also go ahead and do, just a euro shock or things like that. Have the euro go down, have because like we've seen parity on the euro, it's bounced off of that a little bit, but you could shock individual countries too, and it will shock every other currency accordingly, just like it's doing here. So we have the US dollar index going up. That obviously has implications for all other currencies around the world, which are going to have implications for how the EFA and emerging markets perform. And so what you can see is that if we shock the US dollar index up 20%, we have a 20% loss, 21% loss. And basically a 20% increase in the dollar is sort of what we've seen in the past year or so.
Yeah, this is not a crazy shock. We're not like, this is not doing well. We've actually lived through some of that already.
Yeah, and if you see the scenario loss of 20%, that's really not far off of what this portfolio would have done. I'd have to actually test it to see. We have some long, like I said, we have some long bonds here, and we have seen the long end go up quite a bit, even though it's inverted. The short end has gone up more, but we've seen bonds have a very high loss here. We know Bitcoin's had a very high loss, and so a lot of these portfolios, a lot of these holdings, I should look at what the real loss is over this time period. But a 21% loss on this is not crazy. This is not ridiculous.
And you know what? At first glance, this is why you have to stress this. I would tell you, I've been doing this for a while. I mean, more than 2 decades, analysis of portfolios and risks. Just looking at this portfolio, and if you told me that what happens in the dollar scenario, I would not say this is going to go down 20%. Just looking at some bonds and things you have in here with reasonable weights, international diversification. I mean, this is a perfectly diversified portfolio according to the book. But the world is set up and changed in such a way that dollar increase does have a major impact. And we're not even talking about, like, you don't have a lot of exposure to, let's say, China, which is the first country that gets hit when the dollar increases, right? We've seen, I don't know if it's related. I don't know if you're watching the news, but like 4 major banks in China are just not allowing people to withdraw their money.
Right.
I've seen videos from a couple of towns where tanks came out to chase people away from the banks.
Really?
And all they're saying is that, I'll send it to you. I've seen the they're saying that why are they not allowing the withdrawals? Well, it's some system upgrade that's been going on since April. So it started like in May, really slowly, then it snowballed. So some major financial institutions in China are not paying people, are not allowing them to withdraw cash. I don't know if it has anything to do with that, but increasing dollar will put pressure on China. In this portfolio, I don't see, it's not exposed to China, right?
No, with it underneath. No, actually, underneath.
Other than like
market,
Acqui and yeah.
I mean, this might be, I don't know how big China is in the emerging markets.
A little bit, yeah.
Yeah, it's 30%, 20%, something like that. It's a good size, but still, you're talking about.
But it's not. There's no direct. No. If I saw a big Chinese bet, China, I would say, hey, this is a portfolio that will go down when the dollar goes up. Looking at this portfolio as it is, if I didn't stress test it, I didn't do this exercise with you, I would think that it could lose 5% maybe, but clearly not.
Yeah, right. And the interesting thing too is everything in our portfolio loses. And it's not, again, just to stress this, it's not just because the dollar moves up, right? It's because the dollar moves up and these things happen to all these other asset classes, equities, rates. I mean, the dollar move has implications for everything.
Well, it's through the correlations in the model that it gets
exactly
basically propagated to all these assets.
So nothing happens in isolation in these models. And so you have to understand what the implications are of that. So if you wanted, for example, to test the dollar going up while, rates came down or came up, you would put in a rates factor and move that. And there's a lot of work that you can do around these scenarios, but this is just simply the Bloomberg dollar going up and Bloomberg dollar index, I should say, going up, and the implication for all the other factors around the globe. We're not touching those. By the way,
I think if you had some short-term treasuries, that would be the only thing that would do well for you.
That's right. And so I've also brought in this internet factor. One thing that I did want to touch on before we move forward is this distribution here. But this is kind of like the normal distribution that we always see. And over a 1 year period, 95% confidence interval, we can change that or what have you. It's a 21% loss that is essentially a 95% event, right? So
with 95% confidence, we're going to be between negative 21% and positive 33 on this portfolio, 33.8.
Yeah, right. Yep. So basically, this pretty much gets us there, and all we've done is done what happens. And the important thing is not that this is right or wrong. The important thing is why are we here? Like how do we get here, right? And I don't know if any of us, like you said, Daniel, neither you nor I probably would have predicted that a 20% move in the dollar would have been considered essentially a 2 standard deviation event in markets. So I think it's kind of important to know.
But looking at this also, there's another point to be made here. This scenario on the left, this is a 95% confidence. With 95% confidence, you're going to be in this range. Guess what? We're already close to breaching that interval, and we haven't done anything crazy. 20%. So Bloomberg US dollar index goes up 20 more percent. We're like at the edge of our 95% confidence interval. That just goes to show you that while it is not useless, it is really hiding the depth of risk from you, because just with a small step, we already kind of at the edge here.
Yeah. Yep. And the fact this is only supposed to happen, 1 out of 20 years or what have you, that it goes down this far, it doesn't really matter to your client that this is the 1 year out of 20 that it might happen. I mean, you really should be understanding why you get there and doing things to potentially protect yourself if you get there. So that's why I think like you said, it's not useless, but we need to know why. The why is much more important, I think, than what your 95% confidence interval potentially is. So with that, we'll go back to the portfolio here, but let's take the next step. And let's take the next step of shocking this internet sector, which is kind of a proxy for NASDAQ, but it's much more narrow than that. We're really talking about the Snapchats, the Meta, Google, things like that. Because I think this is actually internet and media is the full name here. So if we take this and we shock this down, 20%, say, well, that's not a big
Well, it
difference here.
probably goes down more than 20% just from the dollar. I would say let's
That's
try
right.
again 50%. I mean, because that's
Exactly.
what if
That's
it was
exactly my point. Is what's implied underneath the model is that that's already happened, right? And so this isn't going to change much because this is what the essentially was implied by this move, and which is why it hasn't changed. So if we go down, say 40%, well, now we're getting down to 26% or so. So if we have a correction that's much greater than what we've seen in the internet sector already. So I mean, let's go back here for 1 second. I mean, this is basically what we've seen, and this isn't far off from reality, right? NASDAQ's down. I mean, so this internet sector is down, probably something similar to that. If we actually get worse here, well, this is going to continue to go to that 26%.
We're still at only about, 1.5, 1.7% on the short end of the interest rate curve by the Fed. Remember, they're going to 3.5. What's that going to do to the cost of capital of all these internet firms?
Mm-hmm.
It's going to more than double them. I think 50% loss is a scenario you must test. If you're running portfolios for your clients, you should test it.
Yeah, it's not out of the question. You're halfway there. We've seen some of this. I mean, it could go down another 50% for him here. Sure.
If they, I think at this point, it's the only if is that if the Federal Reserve decides not to raise rates to 3.5% on the short.
Well, people are looking at that too. They're kind of starting to price in, or I don't know if price in is the right word, but they're starting to expect some cuts, right? That they're going to do this. They're going to get the first indications that the economy is slowing, that the consumer is weakening, that the U.S. economy is slowing down, and then they're going to start to cut, or talk about cutting, and that's going to be our savior. So maybe, but
yeah, I think that, and this is just my opinion, not for stress testing, but I think we're going to see there has to be a shock, like everything we've seen. I mean, Snapchat. If Snapchat went out of business yesterday, that wouldn't be a shock to anybody. I mean, it would be a shock of sorts, but it wouldn't be like Lehman shock. Remember that?
Right.
I forgot who it was. Somebody in Congress. I think it was Barney Frank who said, today we had the free market day. It was like one free market day when Lehman was allowed to give up. And look what happened. So I think that what's going on with the Fed, a lot of it is no longer the interest rate market is no longer free. So we're going to have a day where that's so abundantly clear that we're experiencing such a shock that the Fed has the cover to turn around and go back and decrease rates. But I don't think, if people think that because of Snapchat or 20 such snapshots they're going to turn around and start saying, oh no, we're not going to raise rates, I think that's extremely foolish at this point. We're clearly, 5 years ago, I would agree with that, but something is very, very different. They seem intent on going very far and stopping the inflation or whatever their goals are.
Yeah, I would love it if Snapchat went out of business. My kids would stop asking for it.
Yeah, I think there's some social good in there.
I get sick of saying no all the time. But anyways, yeah, you see, like you said, it's a great point. Snapchat is not the economy, right? I mean, it's not something that the Fed's going to say, oh my God, we have to save Snapchat, or the U.S. financial system is going to collapse. Snapchat, if it goes out of it's down 40% or so today. The NASDAQ is down 2%. I mean, it's 2% is not a good day, but that happens in NASDAQ. It's not like, that's not terribly scary, especially after having a pretty good week. There's a ways to go here, but anyways, I think that's kind of what we wanted to talk about today, or just different ways to think about the current environment, what implications these latest moves on these individual companies have, and see what it might look like on a kind of a well-diversified 60-40 portfolio.
Yeah, remember, you must do scenario analysis. If you invest clients' money and you do scenario analysis, you're gonna be very much surprised. I mean, everybody could be surprised and shocked, but you really need to stress test. So we showed you, our goal of our show, Investing Counterpoint, is to show you what's going on in the markets, but most importantly, you can read that without us. But how is that translated into stress tests? And we showed you in these 3 shows, we showed you a bunch of stress tests, that you could use. You could use it to protect your clients. You could use it to win clients, because look, there are a lot of people who understand that something's afoot. If you can come in to a prospect and do some stress tests on their portfolio and explain to them what's going on and the level of diligence that you're providing, right, you're going to be likely to win that client and keep them in this environment. So, do scenario analysis. If you already have a tool that you've built or something like that, if you're really that sophisticated, use that. If not, below the video, we have a link for requesting a demo of portfolio crash testing. That's a tool we use for a lot of these things. If not, you can just go to RiXtrema.com. I'll ask to put a link on the screen to get a demo of portfolio crash testing. If you're one of the users of the system, you have access to us and Jan. We work very closely. And most of our advisors are people who look ahead. They're trying not to be left behind when the S hits the fan. So join the group, get portfolio crash testing. If not, just keep watching the videos, implement the scenarios. The one way or another, you must be doing that.
Yeah, and I think one of the things about that we've talked about in the past that I love about scenarios is we talked to show the bell curve in this video, but telling somebody that they have a 95% chance of not going below 21% isn't a great discussion. I mean, it's just not. I just think we didn't go into the main sheet today, but talking about the whys, like all the different scenarios that can happen and what you think about those scenarios, it just gives you this sophistication that I think is it's a great conversation to be able to have, especially in times of stress when things are happening to the portfolio. It gives you much more sign of control than saying, hey, that's going to happen one out of every 20 years. This is going to happen. Deal with it.
Or 20 weeks, right?
Or 20 weeks, 20 days. Yeah, exactly.
Yes.
Right.
Sometimes things happen in 20 days that you think they're going to happen once in 20 years. It's like, I think these confidence intervals are completely illogical. It's like I'm undergoing some treatment for my back right now. And, if the doctor told me that, this is going to be better, but on 1 day out of 20, you won't be able to walk and it will cripple you. I don't think that's not what I want to hear from the doctor. And you're like a doctor. You don't, if you're saying that with 95% confidence, you're not going to lose more than X, that's essentially you're saying, 1 on a 20 days, you're going to get knocked out. You're going to fall down and be left in the street. But that's really not, the whole risk management is about preventing that type of situation or mitigating it, at least being ready for it. So
being ready for it, understanding it, not being surprised by it. I mean, whatever you choose to do with the information, it's something that you're at least making a conscious decision about. It's not like, oh my God, this happened. You can say, okay, I can deal with this loss. If this scenario plays out, I can deal with this 29% loss. My clients can deal with this 29% loss. They're aware that it's going to happen, but we want to stay this course because there's a chance that it could turn around too. And if you look at what happens on the upside, we're willing to take this, we're willing to take this risk, this calculated risk that at least we understand. So
yeah, like the risk is a cost if you're, if you're expanding risk, you better get paid. You better know where you're getting compensated. If not, then you're just wasting risk, which is money,
Yep.
Risk is money. Well, thank you, everybody. Thank you, Jan. This is our third episode for Investing Counterpoint. We discussed a lot of stress tests. Next week, you're out, right? So
I'm out without a microphone. I'll be working, but I'll be out of the office, so we probably won't do it. I'll be at my kids' climbing competition in Chicago. So
you don't want to do it from the side of the mountain. Do like indoor Instagram style with your phone.
Yeah, exactly. All the mountains in Chicago.
All right, but we'll come back soon and give you some more stress tests, everybody.
Yeah.
Take care. We'll see you soon.
Take care.